Hi, my name is Stuart and welcome to the Investopoly podcast. My goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And in today's episode, I want to talk about investing in the share market generally, which will be kind of the first half of today's episode, and then applying those principles to 2025, I guess, and also having a look back in 2024 in terms of what approaches worked and didn't work. So anyone that's been listening to this podcast for really any length of time probably knows that I'm a very strong advocate for using evidence-based approach, evidence-based investment strategies, regardless of the asset class that we're investing in, whether it's property shares, bonds, whatever it might be. And I believe that if you only employ investment strategies that have a proven track record, where there's overwhelming evidence that shows this rules-based approach has delivered consistently strong returns over many decades, that by taking that approach gives us the confidence that, if we employ the same rules-based approach, we should, over the long run, achieve similar outcomes. And therefore, we minimize the risk of not achieving our financial and lifestyle goals by taking that approach. So why throw darts at a dartboard when we can just find the rules-based approach that's worked over many years? Now, 10 years ago, I wrote a blog about why passive investing is better than active investing, including stock picking. And I wrote an update to that blog about 7 years ago, both of which I think were before I started this podcast. So I certainly thought it was about time to kind of revisit that methodology. And then, as I said, take it to the next step in terms of looking back what worked last year, what do I think will work this year. So global benchmarking business, S&P Dow Jones, they run a lot of share indexes. And they've been building a huge data set of active versus passive. And I probably should explain what is active, what is passive. Active fund managers, if you've been around for a long time, they're the managers that you'll be probably most familiar with. Active managers, their goal is to beat the market. You pay them typically about 1% per annum in terms of fees, and they will go away and pick which stocks they think are the best stocks to hold, and their goal obviously is to maximize returns and certainly beat the index. An index fund is a completely different approach. The index fund's methodology or thesis is picking a winner is like picking a needle in the haystack, and the analogy would be just invest in the haystack. So that is that few active managers can consistently produce better returns than the index. So why bother? May as well just invest in the index. And so S&P Dow Jones have been tracking this data for more than 20 years, so 2 decades, a long amount of data. But there's been even more longitudinal studies than that going out several decades. But I guess this is published online and you can Google it. If you Google SPIVA, S-P-I-V-A, that's an acronym for S&P Index versus Active, you will find these reports online. Of course, I've got a link on the blog on the website to those SPIVA reports. And essentially what they do is they compare the performance of all publicly available active funds to their relevant index. And so here are a couple of the key highlights. I should say they do that twice a year. So they have a mid-year one and an end-of-year one. They follow calendar years rather than financial years. And normally the calendar year reports are published around the end of February, could be early March, sort of around that time of year. So we don't have that data for the 2024 year yet, but as I said, we've got a lot of data. So here's some highlights. Over the last 15 years, more than 85% of Australian actively managed funds failed to outperform the ASX 200 index. So putting that another way, fewer than 15% of active funds actually deliver better returns. But here's the catch. It's not the same 15%, right, over that 15-year period. So let me share some data. For example, of the 76 active fund managers in the top quartile of performance in 2021, and the top quartile, not all of them will beat the index, but that's a good proxy for probably the ones that may have beat the index. So anyway, in the top quartile in 2021, there was 76 fund managers. By 2022, so there's 2 consecutive years. Of those 76, only 16 remained in the top quartile. And by 2023, only 1 remained in the top quartile. So it shows that, some fund managers can beat the index in 1 year. Very few do it 2 years running, and almost none do it 3 years in a row. So to consistently beat the index using active fund managers, what you really need to do is accurately predict who's going to be in the top 15%. So who are the 15% they're going to beat it this year? Invest in those funds. Within the next 1 or 2 years, you need to sack those fund managers and find the new top 15%. And you need to do that consistently well year on year, even though the fact that switching out of fund managers consistently will trigger high transactional and tax liabilities. So that's the Australian data. US data is relatively similar, or more striking, really, I guess. Over 90% of active fund managers failed to beat the S&P 500 index over the last 15 years, where it was 85 in Australia, probably because it's a much smaller market. But again, the same persistence in terms of returns is the same sort of story. So of the active fund managers who were in top quartile in 2021, only a third remained in 2022, so 2 years running, and virtually none. In fact, there was only 2 out of more than 500 were able to produce 3 years of performance. Now, the key thing here is these are professional fund managers, okay? These guys are probably working 60 hours a week. They've got access to all the data, Bloomberg terminals, all the sort of stuff. They've probably got a lot of education and, they're sitting in a room together bouncing ideas off each other. And this is their full-time job, and this is something that they're really interested in enjoying, and they can't beat the index. So what chance does a novice investor have by investing in direct stocks? So when someone comes to me and says, I'm going to buy Rio, I'm going to buy Westpac, I'm going to stick with some blue chips, and I think I can do pretty well. Can you do as well as the index, and how much time are you going to spend doing it? If the professional fund managers are producing pretty poor results, I would have to then assume that a novice investor is going to also produce pretty ordinary results as well. Now, I'm not saying that it's impossible for active fund managers to outperform the index. I mean, the data that SPIVA puts together doesn't include any privately held or restricted funds, so wholesale funds or funds that are only marketed to sophisticated investors and so forth. The data is probably likely to repeat itself, even if you include those people. But there might be some unicorns out there. You might find one fund and they'll have 10 years of excellent performance. It's entirely possible, of course. It's just really, really unlikely. It shows that employing an approach that requires an active fund manager to beat an index is a very high risk strategy. That the chances of actually winning out of that approach are very, very low. And I play the probabilities, right? If I'm investing, again, I want to take the lowest risk for the highest return. And so it's about using strategies that have the highest probability of working. Why would I waste time doing anything else is my viewpoint. There's some other advantages that index funds provide. Firstly, lower turnover. So a lot of actively managed funds that they're buying and selling all the time, a lot of those funds will have 100% turnover within any particular year. That means that if they do make some capital gains, if they're lucky enough to actually invest well and generate some returns, those returns will be taxable in the year that they're derived. So therefore, even if you get 10%, you've still got to pay tax on that 10% return, whereas index funds have much, much lower turnover. There's going to be some distributions because of dividends, but the realized gain as a result of any trading will be minimal, pretty much nothing, which means that if you're going to invest in a market that has low dividends but high growth, it's very tax effective because you're not going to pay tax on unrealized capital gains until you actually divest of that investment. The other thing is lower fees. Active fund managers typically charge around 1%. Index funds can be as low as 0.03%, like a tiny, tiny, tiny fee. And we've got to remember that fees are certain, returns are not. And in years where, in fact, you have a negative return, obviously fees just only make that worse. So minimizing fees is also a good strategy. So overall, the overall sort of theme of this data is it's absolutely compelling that an evidence-based approach using a rules-based strategy, so indexing, makes a lot of sense. Okay, so as I promised, let's talk about 2024. What happened in 24? And then how can we use this rules-based strategy in 2025? Okay, so ASX 200 index did okay, not as well as the US market. 11.55% last year, the ASX 200 index returned. And according to fund manager Van Eck, the bank rally really drove more than half of that return. Okay, in fact, 3 banks drove more than half of that return from the ASX 200. So CBA accounted for about 3.5% of that total 11.5% return. And Westpac and NAB contributed about 3%. So CBA, NAB, and Westpac contributed about 6.5% of a total return of 11.5% from the ASX 200. So that means 197 stocks. So everyone else other than those 3 banks only returned 5% for 2024, which is pretty poor, really. Obviously, the miners, BHP and Rio, were quite a drag on the index last year because of the challenges around China and iron ore and those sorts of things. Now, it's noteworthy that earnings growth was not responsible for driving those share prices higher. In fact, earnings per share growth last year for all those 3 banks was negative. And that's a bit of a concern because if if share prices are rising, but it's because those companies are making more money, earnings per share is rising, then you kind of feel a little bit more comfortable with it. But it was really just multiple expansion. That is, the valuations rose rather than the fundamentals was kind of the sole reason for that performance. Now, I'm not too worried about Westpac and NAB. They seem to be fairly valued. They're trading in around about a forward PE of 15 to 16 times, which is kind of bang on the long-term average. So they look okay. But Morningstar argued that CBA is the most expensive bank in the developed world, and it's trading on a forward PE ratio of 25 times, significantly more than the other banks. That looks a little overcooked. I think the thing we need to think about for 2025 is, will the banks repeat that process? Will they repeat what happened in 2024? Will those 3 banks contribute more than 50% of the gains to the ASX over the next 12 months? It's possible, of course. It's possible those will continue to run. You'd have to think, the balance of probabilities is at some point CBA is going to lose a little bit of steam, and that could be a big drag on the index as well. But it's probably likely that stocks, some of those 197 stocks that didn't do so well in 2024, might be the drivers this year. Now, turning our mind to the US market, it was kind of the same but different. So the S&P 500 index delivered 25.02% in 2024. 25% gain, that's huge numbers, more than double the long-term average. Much of this growth, though, were driven by the Magnificent Seven stocks. The Magnificent Seven includes Apple, Microsoft, Amazon, Google, Meta, so Facebook, Nvidia, and Tesla. And they contributed, those 7 companies, about 55% of the S&P 500's return. And those 7 companies now account for about a third of the total index. So we have quite a bit of concentration risk. In fact, I would say growing concentration risk, because it's something I've spoken about previously in the US market, where we've got 7 companies that really can have a really big impact on overall returns, particularly across the S&P 500. But unlike in Australia, the Magnificent Seven actually delivered really robust earnings growth, about 33% for the first 3 quarters of 2024. Obviously, we don't have the 4th quarter from 2024 yet. So the earnings growth has been strong, which is good because you think, okay, fundamentally, these companies kind of deserve higher share prices. However, to a large extent, I would say that those earnings are already more than factored into current prices. So these companies are trading on PE ratios of between 25 up to 110 times PE in fact, the median across the 7 companies is about 39 times. And if you think about the long-term average in share markets, sort of hovers around 17, 18 times in terms of PE. So more than double these are trading at. If you look at the companies other than the Magnificent Seven, so the other 493 companies, they actually experienced lower earnings growth last year, about 4.2%. So pretty benign growth. However, when you factor in the fact that the Federal Reserve cut rates by 1% last year, and that we've got a pro-business Republican government in place, that you would think that that might boost the ability of the rest of the S&P 500, so everyone else other than the Magnificent Seven, to finally deliver some meaningful earnings growth. And if that transpires, maybe we will start to see some of those other companies start to perform and contribute to the index's growth. So last year I published an episode. In fact, it was episode 113 in July last year I published, where I talked about 4 alternative rules-based indexing strategies. And see, the problem is, or the observation is, that traditional market cap indexing, which is, the sort of traditional indexing that Vanguard typically is involved in, gives investors more and more exposure to growth companies, just because the index allocation, is linked to share price. So as the share price of a company rises, holding everything else constant, of course, it makes up more and more of the index, and so investors have more and more exposure to these companies. So if you're investing in an S&P 500 company, 1/3 of your money is invested in the Magnificent Seven, and it gives you that sort of exposure, which is good when growth companies are going well, of course, but, increases your portfolio's risk. So you look at the growth companies, at the moment, they're trading on a PE ratio about 27 times. That's well above the long-term or 10-year average of 22 times, which is already overstated, because if you have a look at, much longer averages, 27 times is expensive. So growth companies are very expensive now, and you can argue, yeah, they've got the growth, but you're already paying a lot for that growth, arguably paying too much. And to reduce a portfolio's risk, arguably you'd probably want less exposure to those growth companies. And one of the ways of achieving that is to use indexing strategies that break the link with price, that don't use price as a mechanism for deciding how much or how we're going to spread our money across a particular market. And I thought it was worthwhile, just to help people kind of understand this point, is to talk about those 4 strategies that I profiled last year and talk about how they performed last year in the market, and why they still might be worthwhile considering. So let's start with equal weight index. Equal weight index means that we put our money equally across the constituents that make up an index. So if it's the ASX 200, we put 1/200th of our money in every single company that is in that index. Same with the S&P 500 index. 1/500th of our money goes into each of those companies. If we have a look at the equal weight index, what it means is it means we have less exposure to these really large cap companies, and so we get rid of that sort of concentration risk, if you like. The S&P 500 equal weight index currently trading on a forward PE ratio of 17 times. So if you compare that to the growth companies, which I just cited, 27 times, it looks like better value. And remember, it makes sense when you buy an asset and that asset is cheap. Of course, your future returns are going to be better than average. If you buy an asset and it's expensive, it's very hard to make money in that situation. If you look at the S&P index, just the general index, it's trading at 29 times PE. So when we look at performance, however, the equal weight index severely underperformed, about 12%, 12% lower return compared to the S&P 500, and that's just because the Magnificent Seven. But arguably, you're really de-risking your portfolio, and really what you can't really pick is what's going to work this year, but you've got to sort of take a 5 to 10 year viewpoint. And there's 2 things you want to do. It's you want to think about risk and then also returns. If we look at dimensional indexing really did quite well. In fact, beat the S&P 500, delivered 26.7% last year, which was great. In contrast, though, traditional value-based indexes, such as what Vanguard put together, Vanguard has a global value index. It actually slightly underperformed the S&P 500, delivered 19% last year. Not too bad. I think it's a pretty good return when you don't have the risk, the concentration risk that the S&P 500 gives you. And so I think that having a value tilt in your portfolio, again, would make sense, particularly if you want to maximize long-term returns. Value has never been as cheap as it is today relative to growth, right? So again, the starting point is pretty attractive. And the other index, the fourth index I talked about in that episode last year was a quality focus index. And quality did well because typically quality still has some exposure to those Magnificent Seven, although that you still have that sort of quality overlay, if you like. So you're not investing in companies that don't have strong earnings, etc., etc. Anyway, quality indexes return somewhere between 26 and 30%. So again, beating the S&P 500. So we had dimensional and quality beating. We had value that underperformed and equal weight underperformed. And I guess when you use different strategies, that's kind of what you should expect. Because what you're trying to do is accommodate lots of different market conditions. And you're going to get some that are winners and some that are going to underperform. Although all of them produce double-digit returns, so the ones that underperform certainly wasn't a terrible outcome for investors. And I think that really underscores the benefit of using a variety of index strategies. What you're trying to do is minimize your portfolio risk, which I think is really important, but also potentially maximize future returns. And I think, to my mind, both of those things have relatively equal weight. I'm happy to earn a return, but if I'm taking huge risk to do that, I know one day that's going to trip me up. So really what I want to do is add equal focus on reducing my portfolio risk and maximizing my portfolio return. 50% of my focus is going to be on both those factors. So then the way that I'm using that approach is I would say, well, the quality index will give me exposure to the Magnificent Seven, but at least they're going to meet some certain quality metrics so that I'm not really overextending myself too much. Equal weight, on the other hand, is going to offer me more exposure to mid and small cap stocks. So if we see a resurgence there, because they've kind of underperformed, certainly relative to those mega cap stocks, then that'll give me exposure to that market. Dimensional and value focused index will reduce my portfolio risk by tilting my portfolio towards undervalued stocks, and therefore exposing the portfolio to better than average returns, knowing that value has underperformed over the last 10 years, and we know mean reversion will kick in at some point. And that said, there's always a place, in my mind, there's always a place for traditional market cap indexing as well. But by using all 5 of those different indexing strategies, what I'm doing is positioning the portfolio to, as I said, minimize risk and maximize return. And remember, it's impossible to know what's going to happen in 2025. I mean, predicting the market over the short term is like predicting the weather. Who knows what the weather's going to be next week, let alone next month? And it's exactly the same for share indexes. Therefore, if we acknowledge that it is impossible to predict these things, then all we must do is focus on the medium term, which means that what can I do today? How can I structure a portfolio so that 5 years from now, I'm going to look back and go, yeah, I'm really happy with that outcome. 5 to 10 years. That's kind of the time period that we're looking at, because 5 to 10 years, that mega cap situation in the US will play out. Some will be winners and some will be losers. We know that from history. And so the people that are going to be fully invested in just those Magnificent Seven, they're going to suffer pretty poor returns as a result of that. We know the Aussie markets underperform. That will bounce back eventually. We know emerging markets are super, super cheap at the moment. That will bounce back. We know small cap stocks around the world, particularly in Europe, are very cheap as well. That'll bounce back. We know these things will eventually play out over the next 5 to 10 years, most likely. It's therefore, how do I position my portfolios to not only try to accommodate some of the risks that is present over 2025, but mostly about maximizing longer term returns. So there you go. I thought it was a really good opportunity to kind of revisit that active versus passive versus direct share debate and kind of share some of the more up-to-date statistics with you, since I haven't done it for quite a significant amount of time. And then also sort of take that a step further to sort of talk about, how we thinking about these different indexing strategies within our firm and for our clients. And hopefully that gives you a better sense of, how you apply that sort of rules-based approach. Okay, let's get into some questions. I think I can fit some in. Next question is from Tim, and it's a super long one. So, Tim, I'm just going to summarize it for everyone. So it's Tim. I'll just sort of run through sort of the key elements. So, married couple, both in their 50s with 3 kids. They are residing in Western Australia in a mining town, and they've been doing that since 2010. So, been there nearly about 15 years or so. A household income's around 200,000 from mining job, plus 60,000 from a government role, plus some rental income. In terms of assets, they've got about 800,000 as super between them. They've got a Sydney investment property worth 1.8 with $680,000 mortgage, $800 a week rent. They've got a investment property in mining town worth $600,000, no debt against it, $1,200 a week from that investment property. They got some investment bonds, 26 grand, some money in offset, about 70,000 as a sort of an emergency fund. They bought the town house 18 months ago in the mining town. So this is the one that's worth 600,000 with $1,200 a week. And the reason they did that is just in case they were suffered a redundancy, or to provide a foothold for the kids if they remain in that mining town. But Tim's having some problems with the property. The key problems are high maintenance insurance costs, volatility in property value, boom to bust sort of situation, frequent changes in property managers, so difficult to find good property managers, and uncertainty around the broader market's trajectory, and taxation on positive gains. Of course, there's no gearing against that property, and it's producing high rental income. So the question is, should they sell? And option 1 is sell and use proceeds to pay down the Sydney investment property. Or 2, sell and invest proceeds in liquid assets for flexibility if redundancy occurs. So, Tim, I think it's always good to go back to your original investment thesis, original investment decision in terms of buying this asset. And you cited in your question that you did it because you wanted somewhere to live in case you got a redundancy, and you wanted somewhere for your kids to live in case they wanted to stay in that mining town that you live. So my question to you then would be, do those things still hold true today? Are those things still important to you today? Because if they are, and arguably they're sort of non-financial reasons, I mean, to some extent they're financial, but let's say they're non-financial reasons, then it is what it is. That's what you've decided. That's, part of it is returns, and then part of it is risk. And if that reduces your risk and makes you feel more comfortable, then it kind of is what it is. You're in your 50s, and you've got, let's have a look at it. You've got about $1.1 million of equity in the Sydney property, and you've got about 800,000 of super. So that's 1.9 million. Of course, there's some CGT on Sydney, and you're in your 50s, I think. I don't know, it's the early 50s. You're both 50 years old, so 10 years till retirement. You're in a really good position. If that mining town asset doesn't really work for you, like in terms of produce great returns, probably not a big deal. Like, it's not going to put you in a position where you're not going to be able to afford to retire. And so therefore, I think you can prioritize these lifestyle considerations, whether you want to keep that property for your kids or in case you get a redundancy and so forth. If you're going to invest in markets that are a lot more cyclical than other markets, so the capital city markets, as I've spoken about in this podcast before, go through flat cycles and growth cycles. There's markets, particularly coastal markets, mining towns, these sorts of places where demand can be a lot more variable. They will go through more distinct cycles, growth cycles, and then not flat cycles, but they will actually experience property price decline. Look, if you know that you're in that market, then you can kind of time your exit if you want to take that money off the table. I would just be patient around that. Of course, there's probably going to be another boom. China will probably stimulate, that'll probably reinvigorate their demand for resources from Australia, and those locations could experience a boom. So if you're in those markets, I think you just got to make friends with. There's going to be more volatility, and in terms of timing, exit timing, you just want to plan ahead with respect to that, and then take that money off the table. I don't think I would say, unless there's a really strong personal use, I don't think I would say, look, that's a good asset to take into retirement. So maybe it's a case of saying to yourself, over the next 10 years, I'm going to exit this property and I'm going to try and pick not the top of the market, that's impossible to do, but I'm going to try and pick a buoyant market to sell in, and just don't be too greedy by trying to ride that market too long. And you probably will end up doing okay. But if those things don't hold true anymore, so if you don't really, it's not a priority to have that property for your kids, and if you think, well, if I get a redundancy, you sell that property, you can put that money in the share market or wherever, you've got liquid assets to fall upon. If you're of that mind and the property's really doing your head in, well, then of course maybe sell it. Okay, next question is from Khan and Megan. Bit of a long one, but I'll have a go at it. I love the podcast. I've been listening for 4 years. Investopoly is one of only 3 investment podcasts I've stuck with over the years, including Elephant in the Room and Property Couch. They're both pretty good podcasts. I've been a guest on those ones. So thanks very much for your kind feedback. I have a specific question about my family's current circumstances, although I think I can summarize it so that anyone in similar circumstances will benefit from it. And that's what I always try and do with these Q&A episodes. I try and not make them too niche. I try and find what is the key sort of topic or strategy or thesis that sort of comes out of the question, and try and make it so that everyone can learn something. Anyway, I'll get into it. I'll start with an overview of our finances for a bit of a backstory. We're both in our mid-30s and have 2 boys aged 6 and 3. Our family income's $200,000. We have cash savings about $150,000 and $250,000 in super, mostly in my name. My wife is about to start back into the workforce after a 7-year break. I don't know if I'd call that a break. two boys. Anyway, for 1 to 2 days a week. We've got 3 investment properties, a 3-bedroom house in Ballarat purchased in 2015, worth about $500,000, $230,000 of debt. 2-bedroom house in Reservoir in Melbourne, purchased in 2017, $700,000 with $460,000 of debt. 3-bedroom house in Sunshine, purchased in 2019, valued about $900,000 with $640,000 of debt against it. I'm going to guess that Empower Wealth bought all those properties for you. Anyway, the Sunshine was purchased as a primary place of residence and still covered by the CGT exemption until 2026. We moved to Bellingham, New South Wales. I hope I said that correctly, during COVID, and we're currently renting a great house up there that we're super happy with and could stay here for the next 10 to 15 years if it's in line with the landlord's idea of what he wants to do with his property. For retirement, we'd like to have our primary place of residence here, sort of around that area, sort of Coffs Harbour, whatever. And the current price would be about $900,000 to $1.5 million. That's a bit long-winded, although I know you like a lot of detail in your questions listening to previous Q&A. Yeah, I mean, detail's good. Detail's good. Okay, my question is, given our circumstances, loving our rental property in addition to our lack of serviceability to buy anything for quite a while, and the current exposure to the Melbourne Victoria market, would you wait another 10 to 15 years to buy a house in the market we're renting in without selling any of our existing properties? Or would you recommend waiting for my partner to re-enter the workforce, selling one or two of the investment properties, and buy a principal place of residence as soon as possible? I guess to summarize for the community listening and to make it more relatable, do you hold an investment property or properties in an area while renting, rent investing until retirement or close to it with a plan to buy later? Or do you focus on borrowing power and purchase a principal place of residence as soon as possible, even if you have to divest of a few assets? Megan, great question. Unfortunately, there's not a definitive answer in terms of rules-based answer for everyone. It is a little bit different. Typically, just generally, I like to go and buy the forever home as soon as I possibly can. And I've mentioned this in the podcast previously because we have to use after-tax dollars to pay for that property. And that's a very expensive way of buying an asset. Which means that, I've either got to go and get a really big home loan and spend years and years repaying that home loan, or I've got to save a lot of after-tax dollars in order to go and buy that property. And if I don't buy it today and I postpone it and buy it in 15 years' time, of course that property is going to cost me a lot more, and that lot more is going to cost from after-tax dollars. And so that's the general rule. And sometimes for clients, we've had to do that and we've had to divest of some assets. My starting point would be, knowing what you know today, would you go and repurchase those properties in Ballarat, Reservoir and Sunshine? That's the first thing, because we can't let past decisions continue to weigh on us, even if we acknowledge that those past decisions weren't perfect. And so if you said, Stuart, they are all duds, I'm not suggesting they are, but if you said, Stuart, they're all duds, then I probably would say, yeah, wait till your wife gets back in the workforce, divest of those assets, and then buy yourself a family home where you live. However, if you say, actually, I reckon they're all great assets, it's just the fact that Victoria's not doing so well and hasn't done so well for the last 7 years, then in your situation, and particularly given you're inclined, in fact, happy to continue renting and you're very happy where you are, I would be inclined to encourage you to hang on to those 3 investment properties and buy the home as soon as possible, but probably not within the next 5 years, maybe in the next 5 to 15 years, somewhere in that sort of time frame, as soon as possible, but with selling maybe only one of those properties. So I guess what I'm saying is, let's wait. You've done all the hard work over the last sort of 9 years of acquiring those 3 assets. Let them do their thing, right? If they're good assets, they're going to produce a lot of capital growth for you, and let them do their thing. But if you can get in the market and try and tick both those boxes, that'd be great, which means that, for example, you might hang on to Reservoir and Sunshine, and in 7 years' time, after a bit of growth, sell Ballarat. And if you could do that, like if selling Ballarat at that time, together with your current borrowing capacity and cash flow, was enough then to go and buy your home where you want to live long term, then I would do that. But if you couldn't do it, no big deal. Hang on to those 3 investment properties, rent, invest, and then look to buy something down the track when you're sort of closer to retirement. The other thing, you don't want to wait until you're retired, I wouldn't have thought. And you're in your mid-30s, so I would say probably, if you're thinking about working to 60, maybe at 50 you want to make that change, just in case there is some residual non-tax deductible debt as a result of making that change. And the best case scenario would be, in say 10 or 15 years' time, to look at that portfolio, sell the 2 worst performing properties, or the 2 properties you think, if they haven't performed and you form a view they're not going to change in terms of relative performance, then sell the 2 lesser quality properties and maybe keep one long term if you possibly can. Do that before you're 50. Give yourself in your 50s enough time then to repay any residual non-tax deductible debt. And I think you'll find you'll probably be in a relatively good position. The key thing here is the fact that the Melbourne market's likely to enter a growth cycle, and I would say Victorian market, likely to enter a growth cycle within the next 2 years. That's my guess. We'll have a change of government almost certainly towards the end of or at the end of 2026. So I think the market will change somewhere between now and then. And you're likely then to enjoy above average growth over, when the market does enter a growth cycle. So I'd hate to see you sell these 3 properties today, go and buy where you buy, and what you buy might do okay, but you look in the paper in 10 years' time regretting probably selling those 3 properties. But Khan and Megan, thank you so much for the question. It's a really good one, and I hope other people get some benefit out of it as well. Okay, I think I've run out of time. A longer one today, so apologies for that. And until next time, bye for now.